Well, I'd like to go ahead and welcome everybody to our afternoon session of our webinar about alternative methods of funding your health plan. I want to say thanks for joining us. My name is Derek Hayden. I'm a risk architect with Danzig Insurance Risk Advisors, and I work out of our Shelbyville insurance office. Our hope for this session is to keep it short and simple. If you do have questions throughout our discussion, please use the chat box to share those questions, and myself or Garrett will be the ones reading those questions, and we'll have Travis or Darren help us answer those as well. So feel free to ask those questions. No stupid questions. This is a new concept for a lot of people. So if you have the question, there's a pretty good chance that someone else is asking the same question. So feel free to chime in and let us know if you have something you want answered. Once you know, this is being recorded. You as participants do not need to worry about any of your information being shared. So this will only be the panelists that you see right now. Those are the only faces being recorded and the only names being recorded. So you will not be recorded on this session. We will be sending this recording to you and everybody who registered. So if you want to go back and listen to the content one more time or a few more times, we'll send that to you probably tomorrow or early next week. With that, I would like to go ahead and introduce the rest of our panelists today. We have Garrett Ulmer, who's a benefits and risk advisor with Danzig Insurance Risk Advisors. We have Travis Schmid, who is the vice president at Danzig. And we also have Darren Reynolds, president and CEO of Consociate Health. So with that, I'll go ahead and kick it off with our first question. So I guess the reason why we're here, the reason why you guys were interested in joining this webinar, we'll go with the title of the webinar. So Darren, why are so many employers looking at alternate ways of funding their health plan?
Thank you, Derek, for inviting me here to speak today. Derek, appreciate it. Travis, nice to see you. I put up a little stat in the chat line for everybody to see, and I think I probably want to preface my answer with self-funding is not new. It's been around for a long time. And in fact, if you look at that statistic there, as of 2021, 64% of all employees covered by health plans in the United States are covered under an employer's self-funded health plan. So it used to be that the large employers were the employers that were taking advantage of it. After the Affordable Care Act was passed, everybody realizes that premiums have skyrocketed. Choice has gone down. There's 4 carriers typically available for you to get a proposal from. And the rate increases are unsustainable to medium and small sized businesses. So the stop loss reinsurance marketplace responded and saw a great opportunity to take the model of self-funding or partially self-funding down a little level or two to make it a viable option for employers really going down to almost 50 lives. And the reason that the large employers have been doing it, and the reason I saw another stat about what percentage of small employers have gone self-funded in the last 12 months, and I mean it's significant. But the reason that they're looking at self-funding is because primarily it's a lot about transparency, and transparency is a word, sometimes it's overused, but when you're in a self-funded program with what I would consider to be a tier 1 TPA, all of your expenses are going to be transparent. You're going to get reports and data back where the TPA is showing you where every penny of your money, from administrative costs to pharmacy costs to dental, vision, medical, all of those fees, vendor fees, are all disclosed. They're all made part of your proposal. And for the first time, for many of you, especially you groups that are 100 employees or below, you now are going to have access to data to see where your health plan is, the costs are deriving from. And I believe that, what the other factor that's driving this is that there's a strong entrepreneurial spirit that's even come alive even further through COVID, because for the employers that have made it through, everybody had to make sacrifices and changes. And, when you're struggling with trying to keep your business open and governmental mandates and shutdowns, healthcare expenses continued. So the market really has transitioned quite significantly just in the 2 years since COVID started. So employers that feel like they do a great job of running their own company, they understand that healthcare is their number 2 expense on their financial statement. So what self-funding does is it allows an employer to take better control of their healthcare spend. And what we like to phrase that as, we want to take the healthcare expense from being an expense to a performing asset. Because for a lot of middle size and smaller size employers, an effectively run health plan can increase company profits by 1/3 to 50%. And that's a significant portion of revenue that is sitting out there that, could truly impact a small employer. And I know you've got some questions about retention and things like that, but all of those factors come into play. So primarily it's transparency and it's control, and it's, the unknown of not knowing, if the insurance company is making a profit off you or if they're subsidizing you. The unknown drives entrepreneurs crazy. And, there's comfort in paying a flat premium to a fully insured carrier, but there's a lot of questions that exist. And that's a perfect segue into what this discussion is about.
Perfect. We're going to ask a few survey questions while we continue here, and feel free to chat those in. First one is we're going to ask is, are you happy with what your current insurance premiums are? So if you want to chat that in the box there, that'd be great. Travis, I'm going to ask you a question as far as Darren talked a little bit about the Affordable Care Act. Can you tell us a little bit about the Affordable Care Act medical loss ratio?
Sure. What the Affordable Care Act does is it guarantees that the insurance company is going to spend 80 cents on every dollar they bring in, or they're going to have to give that back to the employer. So basically, in essence, what you're doing is you're giving the insurance company a 20% profit margin to operate, for their bricks and mortar. So when you go to a self-funded plan, you're basically removing that expense and you're taking that risk on yourself and becoming the insurance company. So that's where the loss ratio is going to help you as far as your expenses go to control. You're going to put mechanisms in place, and you can pick your plan design, and you're not subject to all the federal mandates or state mandates, just federal mandates under your plan.
So some of those mechanisms you can put into place, Travis, there's several things it sounds like employers are able to do to control their cost. What are some of those mechanisms? Travis first, then Darren. If you have any other ideas, feel free to chime in.
Yeah, mechanisms you can put in place are pretty simple. Like I said, you're subject to the federal mandates and not the state mandates. For example, in Illinois, if you have 20 employees or more, you must have infertility coverage on your plan. And on a federal mandate, you're not mandated to cover that at all. So you can work around that. You can limit that benefit, whatever you want to do for that benefit. Your plan design. Your plan design is subject to, like I said, the federal mandates only. So you can tailor make your plan to fit your needs, not what the insurance company wants to do. So you can pick the best in class vendors to have the best pharmacy manager, the best PPO network that fits your needs. Whether you're a regional operation or a local operation, those your UR vendors, utilization vendors, the number you call on the back of your card, you can loosely manage your plan or tightly manage your plan. Those are the type of mechanisms that we would look at putting in place for those groups.
So you mentioned maybe a little bit about pharmacy, the pharmacy side of things. So I know a hot topic in the news right now and for the past several years has been drug rebates. And I know employers have probably heard a little bit about it. Darren, would you be able to explain just a little bit about what that is and how self-funded groups are able to utilize that to their advantage when it comes to controlling the cost of their plan?
Certainly. We get asked day in and day out, what's the cost savings to going self-funded? And, we typically share with employers that, and even the largest captive in the United States that has 1,800 employers in their captive, been tracking data back now for nearly 12 years. They're seeing an average of 7.5% savings the first year. And that's mirroring the current plan design that was in place with the fully insured carrier. Those savings come from a couple different levels, and one of the larger ones, as you mentioned, is the pharmacy benefit plan. If you've been following the stock market and looking at the fully insured carrier stock prices, it's gone through the roof. And a lot of that has to do with the fact that most of them have either purchased one of the largest pharmacy benefit managers in the nation, or they were purchased by a pharmacy benefit manager such as CVS buying Aetna. So within the fully insured world, that those that are fully insured have been operating under, you've been insulated from knowing much about rebates, because the insurance companies retain 100% of the rebates. In a self-funded, partially self-funded world, 100% of the rebates make it back to the employer. And kind of give you a little bit of an idea of what the savings are, it generally equates to about 6 to 7% of what you were paying on a fully insured premium are available back to you in rebates. And these rebates get submitted back to you directly. They're checks that you use. Most of the employers are using it to offset the expense of their health plan, but that's significant. You also have state premium tax where, when you're fully insured, there are 3% in the state of Illinois, 3% premium tax added to the premiums to cover the state of Illinois's grab for tax dollars. In a self-funded environment, you're only paying premium tax on stop loss premium, which is a small part of it. So you've got 6 to 7% in the pharmacy benefits, 3% state premium tax. And then, as Travis mentioned, you have all these state mandated benefits that may not apply to your business. When you're fully insured right now, you're paying for fertility coverage. I think they say 9 out of 10 employers never use fertility coverage, or any of their employees or covered members. So in the fully or the partially self-funded environment, you have the ability to carve out those benefits that are not really necessary or maybe not needed by your population. Those are low-hanging fruit, and that's where that 7.5% comes from. It's a simple math calculation. Right out of the gate, you've got an opportunity for savings, and that doesn't even get into the rest of the conversation that Travis talked about, and that was getting into best-in-class vendors and all of the components that happen behind the scenes in a health plan, like pre-certification, case management, large claims management, disease management, subrogation, numerous types of services go on behind the scenes. And in the fully insured world, you're assuming that those carriers are doing a good job on managing all of those costs. In the self-funded world, we go to the high performance marketplace and find the vendors that are doing the best job. And the difference being that there are entities that solely do each one of those tasks, and they do it very, very well. They're very innovative. They're using artificial intelligence. They're using technology platforms. They perform at such a high level that the fully insured carriers cannot compete. And that is why a majority of the large employers have been self-funded, because they've been taking advantage of these subcontract vendors within their health plan to help contain costs along the whole spectrum. So lots of opportunities, ways to save dollars without changing your plan design. Self-funding is not about shifting higher deductibles and higher out-of-pockets to your members. It's generally about trying to improve your benefits, steering them to providers that are inside the network or that have better outcomes than others, and improving the health and performance of your staff.
Perfect. Travis, I'm going to kind of direct this next one to you. I know when Derekh and I meet with business owners, one of the hottest topics today that we're hearing is gaining good employees and retaining your key employees. Tell us a little bit how self-funding can help an employer offer more competitive benefits to try to retain and attract the best employees in their area.
Yeah, that's Great question, because we get that. We suffer from that ourselves trying to recruit and retain employees. So the nice thing about a self-funded plan is you can include benefits. I think Darren alluded to this earlier. You can include dental, you can include vision. Like on our dental plan, for example, we went to 3 cleanings a year on our plan. Well, your industry standard for a fully insured dental plan is 2. Short-term disability, you can add that to your plan. And you can customize your plan, and you're not at the whim of the insurance company. So the insurance companies, anybody that's been on an insured plan for any length of time knows that the insurance company changes things when your policy renews. And then you have this gotcha at the end of the year, or when you're getting to roll everything out for your employees, and you have to communicate to your employees that this drug changed, or this copay changed, or the deductible went up, or the out-of-pocket went up. So you can have consistency in your health plan so that when HR is communicating benefits, they know exactly what happened and they know exactly what to do. And you can change your benefits to adjust and adapt to your needs. Even on our own plan, we have increased benefits in certain areas where we needed those. We went from a fully insured plan long time ago to a self-funded plan for that reason, just so we can adjust and adapt easily to market trends.
And I'll add on a little bit to that, if you don't mind, Garrett. Some of the other things that happen, that I believe are key factors in helping retain is not just the savings. And generally speaking, again, when you've got 55–60% of the large employers being self-funded, you obviously know that it's a lesser cost alternative than the fully insured. But beyond that are the benefits that Travis mentioned, the way you want to set up your contribution levels, what the employees are paying for coverage, consociates employment or workforce. We have a lot of females that work for our company, and we have a lot of them that are single mothers. And what we found out under traditional premium structures, it's very difficult for them to be able to afford coverage for their children. And going to the exchange today is a little bit of a mess, and not really where we wanted our people to have to deal with. So what we've done is we've leveraged our premium contributions in favor of that class of employees, meaning that we charge less than definitely than what it would cost them if we were fully insured. And within a self-funded plan, you're able to do that. And it's meeting your people where they're at, not meeting and not transferring premium based on what your fully insured carrier is providing. The other area that I think where there is significant opportunity is typically in the self-funded world through a third-party administrator, the service is not available through any of the fully insured markets. There's 4 carriers covering 65% of the population in the fully insured world across the country. It's very hard for them to provide personal service. TPAs like Consociate, specifically, we have live individuals that answer the phone call. So when the members call in, they're talking to a live person. You call any of the other fully insured carriers, good luck. Probably going to have to leave a voice on an automated system. So when you ask employees and when they're surveyed, 2 interesting questions. When they ask employees what value they feel like they get from their current health plan when they're fully insured, it's like 20 cents out of $1 is what they feel like. The other concern that they have is that it's too hard to access. I try to call the phone number on my health card. I can't ever get a hold of anybody. It takes 8 days to get a response back. And, those are at times when people are in need. So we focus a lot on that, and we help sit with the employer and let them kind of take the health plan and help it add to the culture of their company. So they're providing specifics, certain types of coverages or certain types of services that are unique to their company, where their employees feel like that 20 cents is going up to 50 cents or 75%. You're probably never going to get anybody that says they're getting 100% value, dollar for dollar out of everything. But, we can work on getting those satisfaction levels up considerably.
Travis, you talked a little bit about how Danzig structured their own plan to help their specific employees. How many, I guess the question would be, how many employees do you need to have before you can consider self-funding as a viable option? How many if you're comfortable sharing how many are on Danzig's plan, just as a reference for people listening.
I think we're somewhere around 100 employees between our two companies on our plan right now. But to answer your question, I mean, there's alternative funding methods that are available for 25 employees plus. And there's level funded options, which is slightly different than a self-funded option. And generally speaking, you know, we would always say somewhere in that $400,000 to $500,000 a year in premium. So in that 25 to 50, depending on your risk tolerance, would be the minimum amount we would ask.
Perfect. So big question I'm sure a lot of employers have now, especially in central Illinois. There's been a lot of network disruption from carrier to carrier. There's certain facilities and providers that are no longer in certain networks, or they kind of take turns dropping a provider, then they get them back, and then they drop another one. So how can an employer combat that constant fluctuation within the networks that fully insured carriers are experiencing? How can they combat that as an employer if they're on a self-funded plan?
The consultants that work for the employers, such as Danzig and Shelbyville, typically work with the client, do some due diligence, and find out, you know, what geography the employers are located in, and then they work through us with PPA and our stable of PPO networks. We send data off to them, and we're able to pinpoint which network provides the best service, best savings, best access for the specific employer and their members. We also have a separate division within Consortia that makes us a little bit unique in that we also do direct contracting. So an employer comes to us and said, hey, you know, the HealthLink network is great, but this provider is not in the network. We have a contracting team that will go out on the employer's behalf and negotiate access with providers. And we're generally 99% successful in filling gaps in the network. The other thing that I would say that's kind of unique, and the PPO question kind of adds to that conversation, and that's about the flexibility in your plan. When you become self-funded or partially self-funded, this really is your employer ABC health plan. You're taking risk, but not the same risk that an insurance company is, but your plan is your plan. All of these sub-entities that are involved, like the PPO network or your stop-loss carrier, they're plug and play. If you have a PPO network and maybe a big healthcare system in your market drops out of that network, we can pivot generally within 30 or 60 days, which the state requires that they give 90 days notice of a change. We're able to swap out one network for another network very quickly, and it doesn't change your core benefit design. The same thing happens on the stop loss. Every year, Danzig and Shelbyville, for their clients, they're checking the stop loss market, making sure that the stop loss premiums are competitive for the employer. And, you know, if they find out that there's another carrier in the marketplace that's more competitive and the risk is no more adverse, then you can move your stop loss insurance company without having to change your benefits. And that's just huge. And again, that's why large employers have done this for years, is because they can make changes to fixed cost items and things like that without having to change the core benefits. So the employees aren't going through, oh shoot, here we go, we're moving from employer or insurance company one to insurance company two, I wonder what's different. All the benefits can stay the same while you change these components behind the scenes to help keep the plan even more competitive.
We've used the terminology a lot today, self-funded. And I know for a lot of business owners, that can be a scary word because they might feel like they're on the hook for, you know, every expense for their health plan. Can we give or maybe in the past, they've tried a self-funded plan. Can you tell us a little bit about how a self-funded plan works and how things have changed over the past years? Darren, whichever one of you, I'm sorry.
It doesn't matter.
Okay. I'll share a little bit of an answer with you guys. So first of all, I shared on the earlier session, you know, I think the word self-funded was created by the fully insured carriers, you know, to put a black mark on the industry, because nobody is really self-funded. Maybe some Fortune 100 companies would go completely self-funded, meaning that, they're taking 100% of the risk. Self-funded, we like the term alternative risk financing and alternative risk options, kind of like the title of this seminar, because what you're doing is basically determining what level of risk you want to take. Much like when you buy a home and you buy a homeowner's policy, you decide what deductible you want in the event of a loss. Being partially self-funded or self-funded is the same. You basically are going to look and see what type of a deductible you as an employer are going to have on each belly button in your health plan. And everybody's risk tolerance is different. Some people are flush with cash and maybe risk is not really a big issue to them. They're looking solely at the large picture and gonna have a better product. We're gonna have better customer satisfaction, and if it costs a little bit more, they don't really care. But the reality of it is that the stop loss market has responded significantly to where it's competitive more frequently than it is not, and that the programs have protections in it that we can essentially mirror the same fundamental way that you've been handling your insurance plan, where you would pay in a monthly maximum amount every month. That's going to be very similar to what you were paying with your fully insured plan. We process and pay the claims out of that kitty. The stop loss carrier has protections in there that if you have somebody that has a catastrophic claim, you're not responsible for anything on a monthly basis more than what your monthly maximum is. But at the end of the year, in your kitty, if you've got money left over, which by the way is in your own bank account, that money stays with you. You didn't advance it to us. You didn't pay it to an insurance company. It's sitting there, and that money stays with your company and can be used for future expenses or returned back to the corpus of your employer. So,
Darren, I think that goes back to what we always say, that you're not insured, you're deferred, because you're pushing your claims down the road, and eventually it's all going to come back to you when you're on an insured plan. Your costs that you're spending are going to eventually catch up with you.
yes, and it used to be that they might catch up over 3 or 4 years, and the reality of today is they're going to catch up in a year. And I think we talked about, the average rate increase, I think, in the United States last year was around 9% on the fully insured market. But that number varies from employer to employer. And there are employers now receiving 35% rate increases. And for a small employer, that's hard to swallow. We do not see those swings in the self-funded world, even on the smaller employers, which I think is a testament to the way the market has responded. So definitely worth a consideration. The numbers we talk about, it's the process of getting a proposal. Your consultants that are here on the screen with you put together pretty good financial analysis, and the numbers are going to show you whether partially self-funding is a viable option for you. And I mean, the numbers can't lie. I mean, there can be risk. The risk could be greater than what you're wanting to take, and you're going to stay. And I know that these gentlemen on the phone, they do a lot of innovative concepts inside fully insured plans as well, to try to wean employers into taking maybe a little bit larger risk.
Derekh, you kind of went over an example earlier today in the first session. I think you've got a great example of a group that was a little timid at first. You'd met with them for, a couple years. They were a little scared to kind of make that jump to self-funding. Can you talk a little bit about that, and then the effect that it has had on them since they made the move, and what made them make the move?
Yeah. So we had met with this group here in Central Illinois for 3 to 4 years. They every year looked at a self-funded option through one of our captive partners called Pareto Health. But they looked at it, and each year they said, well, our renewal we can't make the jump. But they kept getting a 2%, 1%, 4. And they were pretty content with those smaller renewals from their fully insured carrier. Well, all of a sudden, they got a 70% renewal from their fully insured carrier. Well, now they hit the panic button, which unfortunately, whenever you take the large increase, it's not always the most advantageous. It's when you're getting those small increases is when your plan is running very well. So neither here nor there for that group. They had the 70% increase. we did a claims analysis and we were able to identify that the main reason there was one big claim, the reason for that large increase was an illness that was going to cost around $500,000, expected to be around $500,000. And we found that it was actually a spouse that was on the plan. So we looked a little deeper at that plan and noticed that there was only 3 spouses on the entire plan. So through the Affordable Care Act, what you're able to do is you can carve out spousal coverage. So the employer elected to do that because they wanted to make sure they were still able to afford to offer coverage to their employees, which are key to their business. Not that the spouses are not important to the business as well, but they wanted to make sure they could still afford coverage and continue to offer their plan. So we carved off the spousal coverage and we found an alternate option for those 3 spouses that were impacted. Well, what that did, that entire next year, their claims expense was reduced by 54%. Their entire cost for their health plan was reduced by 54%. And that 54% was not on their renewal. It didn't calculate the 70% increase. That was off of what they had paid the year prior. So they reduced their cost by over 50%, and they were able to pass those savings on to their employees. I believe they gave a bonus around Christmas time to employees as a part of that savings to say, hey, you guys did a great job for participating in our wellness and being involved in our plan. We were able to reduce our cost, and we want to thank you for doing that. So that helped obviously retain key talent when they got that bonus. And they announced that was a part of employees' participation in the health plan and the wellness incentives. And of course, they were able to attract some new key talent when they were able to communicate that to potential hirees, saying, hey, this is something that we do. And we're able to, use that to our advantage. So they positioned themselves very well. And that was 3-4 years ago. I can't remember when they moved to the self-funded platform, but they've maintained that same cost. They've gone up a little bit, but also their enrollment has also gone up. So they've been able to maintain that cost from year one for the next 3 years. So they reduced their expense by a large amount.
Gotcha. Travis, I've got a question for you. This is something we discussed earlier as well. Maybe a group is timid to make the move to self-funding. Could you tell us a little bit about some strategies that you can work with on a fully insured group to kind of start transitioning them to the idea of how self-funded plan would work and how it can affect them?
Sure. What we like to do is we like to meet with employers, see what type of plan they're offering. Let's say they're offering $1,000 deductible. We'll go in and we'll get proposals from the same carrier on, let's say, a $5,000 deductible, and we'll do what they call a health reimbursement arrangement, or an HRA, and we will self-fund the gap from $1,000 to $5,000 through our TPA consociate and reimburse those claims through the TPA to give them kind of a baby step into self-funding, because it functions very similar to self-funded platform.
And Travis, do you know the percentages, approximately what percentage of your employee base or member base typically reaches their individual deductible on an annual basis?
17%.
There you go. Not 18, not 16, 17.
Yeah, well, I have stats from many, many years, and we track that.
Gotcha.
That's the nice thing you do is you get that report and you can see your money that's going out the door. And then if you want to look at a self-funded plan, you'll have an idea of who would reach a higher deductible even than the 5,000.
Travis, how hard is it for a group? Let's just say they, maybe they're kind of on the fence and are like, hey, I'd like to get an idea of what a proposal would look like, or an idea if self-funding would make, sense for our group. How hard is it to gather the information, and what does it take to look at something like that?
Oh, it's very simple. We need the last 3 renewals that will have the current rates and the renewal rates, the actual letter from the carrier. And if it's mid-year, obviously we won't have their renewal, but maybe 4 renewal letters from the carrier, then a census which includes the date of birth, gender of all the participants, home zip codes, so we can do an analysis of the PPO network like we talked about earlier, and their plan design. So it's fairly simple. There's not much to it.
Yeah, we had a good explanation in the morning session of how to visualize how the fully insured carriers work, how the fully insured premium works. So as an example, let's say you're paying $500,000 for your insurance premium for the year. So what you're doing is basically you are advancing your claims dollars to the insurance company to pay the claims on your behalf. So the way that works, going back to how Travis explained the medical loss ratio, if your claims come in at $400,000, let's say $450,000, whatever happens to be, that money that was overspent by you stays with the insurance carrier. What if your claims cost more? Let's say it's $600,000 and you paid $500,000. Well, that's when you get your renewal increase. And so basically all you're doing is you're still self-funding your claims, except for it comes in arrears. It happens at renewal. So you're paying for your claims when you get your renewal. So everybody is, going back to what Darren said, is basically self-funded right now. It's just in a different mechanism for how you're paying those claims.
I know we're getting close to time here. If anybody has any questions that they would like to put in the chat box, please feel free to, chat those in and we can try to answer those here. We want to be respectful of everyone's time. We've got about 5 minutes or so here before we need to shut things down for everyone.
I think while people are posting questions that they have, and I just want to reiterate the underwriting process and where the load and the lift comes from. So really it is the easiest proposal that you can almost receive. There is no individual underwriting. Travis mentioned it's 3 years of renewals and your current renewal, a census, and your current plan design. The rest of the heavy work is done by us and our stop loss partners, securing the proposals and coming back and putting it into a spreadsheet. So, we're a TPA. You can say we have a vested interest in it, but we always tell everybody there really is no reason why you wouldn't want to take a look at a proposal. Even at the first year, it's just, hey, I'd like to kind of get my feet wet and see what this would have looked like. Derekh mentioned to you, he had a group 3 years running, before he picked up the account. That's not uncommon, and these guys don't mind investing some time in your account early on, even if it's something that you're not serious on. But until you look at an actual proposal and have somebody explain it to you, you're not going to really understand how it works, how it functions compared to where your fully insured plan is. So it's definitely worth taking a look at, and it is not a heavy lift or load off of your plate. Everybody, we understand, is stressed for time, and everybody's overworked, especially in HR departments or ownership categories. So we completely understand.
I think that's it, guys. I don't see any questions coming in just yet. Anything you guys want to leave the crew with or the participants with?
We're always available. If people have questions, I know they can funnel them through Danzig, and they can get with us, or a lot of the answers are probably going to have themselves. But I would just say, if you don't have any questions right now, but you get home tonight or tomorrow and you're thinking about it, let these guys know what your questions are, and I promise you that we'll give you a quick response on our end.
Yep. And before we hop off here, I just left some of our contact information. Also on our danzig.com website, I left a QR code here. There's a really good page on our website about, the basics of self-funding and how it works, and ask some questions on helping you identify if it's a right solution for you and your group or not. But feel free to reach out to us. Thanks again for joining. And I think we're good to wrap it up.
Thanks for your time. Have a great day.
Thank
you all.
Take care.